Capital gain, as it refers to real estate, it's really kind of simple. It's basically the profit you get above what you bought a property for when you sell it. That's kind of a convoluted way of saying it, but let me give you an example and I'll talk about it. Let's say you buy a property for $1 million, and let's say you hold it for 3 years, for just an even number or an odd number, and then let's say that then you sell it for $1,200,000. And we're going to assume for this example that you didn't spend any money on what we call capital improvements during the 3 years that you owned it, just maintain the property. So at the end of 3 years, you sold it and you made $200,000 more. $1,200,000 is $200,000 more than $1,000,000. So your capital gain, or your gain on your capital you invested, is $200,000. Does that make sense? It's on the total purchase price of the property. Now, it has nothing to do with how you financed it. You may have only spent $200,000 down and borrowed $800,000, made payments on that property for 3 years, and then sold it for a $200,000 profit. Huge return on your investment, different number altogether than capital gains. Capital gains is just that difference between your purchase price and the sales price. Now, there's some variables, of course. That's simplistic. When you own a property, every year you depreciate a portion of it. Real estate, believe it or not, is depreciated over, I think, 39 years. So if you have $1,000,000 property, roughly 2.5% of it is depreciated every year, or $25,000. So on a 3-year deal, if we assume there's no other improvements, each year you have depreciated that $1,000,000 by $25,000. So your capital gain would really be over 925 to 1.2, or $275,000. That'd be your true capital gain, because you've depreciated a portion of the property over the first 3 years you owned it. It even gets a little more complicated. As you spend on the property, there are some expenses that are what we call normal expenses. Painting a room, paying a water bill, paying an electric bill, that kind of stuff that's just part of owning a property. But when you do a major improvement to the property, like a new roof, or maybe a giant remodel that's above and beyond, you depreciate that over a number of years, which means you don't just expense it in a given year. Because of that, it actually increases it, meaning instead of $1,000,000, let's say you put a brand new roof on it and that roof costs $50,000. You effectively paid $1,050,000 for the property, and then you depreciate the $1,050,000 over however many years you decide, and you can actually depreciate the roof at a different rate than the property. But for this example, let's assume it's just the same rate as the property. But you can depreciate that, and then you balance that against the depreciations, against the gain, and you get a different number. So it's simplified. It's just the gain, the profit you make in selling the property above what you bought it for. The complicated is you got to account for depreciation, and you got to account for improvements that you do not expense.